Hello, Joe Follico again for Insignia Futures and Options. In this video, I'll be explaining the benefits of using options instead of stop orders, so don't go away. As an investor, you may or may not know that the use of a stop order does not guarantee a fixed amount of risk or loss. Most futures traders experience price slippage at some point when using stop orders. For those not familiar with this term, price slippage, this simply means that your futures order did not get filled at the price your order specified. For example, let's assume you have a sell stop order working at $18.04 an ounce in the gold futures market. If the price of gold drops to your stop price, it triggers your order, which then becomes a market order. Your order will then get filled at the current bid price. If the current bid price is $18.0380 when your stop price is hit, then that's where your order will be filled. The difference between your stop price of $18.04 and the price where the order was filled, $18.0380, this is considered price slippage, in this case 20 cents, or $20 for a gold futures contract. Now let's look at another possible scenario that could incur much greater losses. In this example, we'll use the wheat market. You decide to go long wheat futures at a price of $12.20 per bushel. You'll feel comfortable risking $600 on this trade, or 12 cents, the value at which wheat futures prices are expressed. You place your sell stop order 12 cents below your entry price at $12.08, and now you feel good that your futures position is protected. However, later that day, wheat prices drop and close at $12.08 cents, just a half a cent above your stop price. The following day, some bad news comes out which affects wheat prices, and the market reacts by opening down to a price of $12.03. As wheat futures prices have moved past your stop price of $12.08, the stop order is triggered and you will be filled. Unfortunately, you won't be filled at your designated stop price. Instead, you will be filled at where the market is currently trading, in this case $12.03. Your 12-cent risk on this trade has now turned into a 17-cent loss, or an $850 loss, $250 more than you wanted to risk initially. That's a bad outcome, but it could have been a lot worse. Some markets, like wheat futures, have what are called limit moves. Limit moves are the amount the futures exchange allows for a market to move either up or down in a trading session before they'll halt trading. For wheat futures, the current limit price move is 70 cents. Using our wheat futures trade example again, if prices open down 70 cents the next trading day, the exchange would halt trading so prices could not go any lower. The term for this futures market condition is known as lock limit down. For the rest of that day's trading session, prices could only move up from the limit down price. I've seen many times when a market stayed lock limit for the entire trading session. But for this example, let's say prices did move up from the down limit move a half of a cent to $11.39. You would then be able to exit your long position. However, you would have an 81-cent loss on this trade, or $4,050 loss, not the $600 you were initially willing to risk on this futures trade. Now, I'm not trying to scare anyone away from trading. I just want to make sure traders are aware that a scenario like this can occur. I hope you're finding this video informative. Please take a moment to click the like and subscribe buttons below if you'd like to see more videos like these. With the above wheat futures trade example in mind, here is a method that may have prevented such a huge loss in the same trade. Instead of using a stop order, you could have purchased a put option in the wheat futures market at the same time we bought the wheat futures to set up a protective hedge. Here's how this method works. Again, we buy a wheat futures contract to establish a long position at an entry price of $12.20 per bushel. We then purchase a $12.20 put futures option to protect the trade. If the futures put option has a premium cost of 18 cents, then the cost of buying this protection is $900. Wheat futures and options are valued at $50 per cent. As we were able to purchase this futures option at the same strike price as our futures entry price, $900 is the most we could lose on this trade, excluding commissions and fees. Even if we'd had 2 limit down days in a row, we would still be locked in at an 18 cents loss. This is because as the futures contract is losing money, the put option we purchased is gaining. When implementing this hedging strategy, there are some considerations that need to be reviewed, as this method does not work all the time or in certain market conditions. The first consideration is determining the cost of the futures option you wish to purchase to hedge your futures position. If the price of the option is too high, then it may exceed the amount of risk you are willing to accept for the trade. You also have to account for the cost of the option when calculating your profit potential for the trade. In this example, we paid 18 cents for the futures put option. If our entry price for the wheat futures position is $12.20, the option cost must be added to our futures entry price to determine our break-even point. In this example, our break-even price would be $12.38. This is the cost of the option plus our futures entry price. Wheat futures prices will need to be trading above $12.38 before any profit can be realized. And don't forget to account for commissions and fees. Using this type of futures hedge in the right market conditions may save you from some serious price slippage on your next futures trade. If you'd like to learn more about how to implement this hedging method with your futures trading, or if you have any other questions, please leave them in the comments below or feel free to contact me directly. I'll be happy to help.